This is Michael Cann, and this is our market commentary for the week of May the 13th, 2013. It was a positive week for markets last week as the TSX gained 1.1% and the S&P 500 rose another 0.9%. Year to date, the TSX is up a mere 1.25%, while the S&P 500 has gained 14.5% and has moved to new all-time highs. It's a sizable outperformance by the U.S. market, to say the least. So, why is the market rising, and why the outperformance in the United States versus Canada? In my opinion, there are three primary reasons. One, interest rates. Two, weakness in commodity stocks, both energy and metals. And three, foreign capital flows. First, let's start with interest rates. Rates around the world are very low, and in the U.S., as indicated by this chart, they are at the lowest level they've been in at least 150 years when you look at the 10-year yields. Investors are not being paid to own interest-bearing instruments with 10-year yields below 2%. So investors are venturing up the risk curve to find yields and some growth. This largely explains why investors are going back to the equities markets. As the economy strengthens, earnings grow, balance sheets remain strong, and rays of confidence emerge in the U.S. economy. But Canadian markets are facing weak energy and commodity prices as the stocks push lower. And these stocks make up half of our indices returns. Agreed, commodity prices are somewhat lower, but the stocks in many cases have plunged to much, much lower levels than the commodities have. Further, this weakness requires global economic growth, which continues to be uncertain even as the U.S. strengthens. Another hurdle for Canadian energy is the growth in the U.S. energy production, which has caused Canadian companies to accept discounted prices from U.S. refineries. These reduced revenues show up as weaker earnings and reduced growth. Canadian companies are facing a number of challenges. Finally, for a decade, Canada was a global leader. Our markets outperformed, our currency rose, and foreign capital flowed to us. Our economy offered a safe haven. Now, other global markets are offering better opportunities at cheaper prices, and I believe money is flowing out of Canada to other global opportunities. That's money flowing out of our capital markets. Some believe that we were in a multi-decade global commodities supercycle, and we may well still be so. But prices and opportunities in other markets are drawing money away. So, I will be closely watching capital flows data as reported by the Bank of Canada in the coming weeks to confirm this assertion. So, where does this lead us? Given yields, we must continue to look to buy quality dividend yielding stocks and accept some volatility rather than pay for fixed income yields that cannibalize our futures. Further, we must continue to buy assets beyond Canada's borders, in particular to start in the United States. We'll watch for another run in energy and material stocks, but for now, they are out of favor even as the prices have become attractive. So they must be minimized in portfolios for the moment. That's it for this week. Thank you for listening, and best wishes to you and your family.